An investment bank acquires a successful independent training company, handing over a multi-billion-dollar payout to absorb the smaller firm. This massive outgoing cash flow creates an immediate accounting problem. The acquiring bank cannot simply write "bought a company" on their balance sheet to justify the missing funds. They have to account for what exactly came back in return. Without reporting rules, executives could invent asset values to cover the expense. They could use creative accounting to inflate their earnings per share and mask operational losses from their investors. Preventing this financial illusion requires a framework that forces corporations to mathematically prove the value of what they just bought. The first foundational step in this process is consolidation. When a parent company exerts influence over another entity, accounting rules require them to merge their financial statements into one unified group account. That concept of control is dictated by specific metrics, like holding a high voting percentage, or through variable interest entities, where the parent absorbs expected losses. Before accountants can allocate a single asset in this consolidated statement, they must isolate the raw, true cost of the transaction from the surrounding noise. This diagram shows the total capital spent on the deal. The top slice includes the banker fees, legal costs, and valuation consultancies. Those cannot be added to the asset's value. They are expensed immediately as sunk costs. Stripping away the transaction noise leaves us with the validated purchase price. Accountants now begin breaking down this unallocated value into its specific components. We start with the physical. A slice of the purchase price is allocated to tangible assets, equipment, real estate, inventory, and physical liabilities. These cannot be recorded at historical book value. They must be adjusted to reflect current fair market value. Because modern corporate value is rarely tied entirely to physical machinery, these tangible assets usually account for a small fraction of the total price. This leaves a large gap of unexplained money. To justify the rest of the purchase price, accountants must identify and categorize the hidden, intangible value within the acquired company. To earn a spot on the balance sheet, an intangible asset's future economic benefit must be probable, and its fair value must be reliably measurable. This flowchart represents the logic used to filter these assets. To be recognized, the asset must satisfy one of two conditions. Is it separable, or does it arise from contractual or legal rights? Separable means the literal ability to divide the asset from the company so it can be sold, licensed, or rented independently to a third party. This framework prevents executives from pointing to vague ideas like market synergy and recording them as hard financial assets. Let's apply these rules to the training company. We start with the company's established brand name and its proprietary patents. Brands and patents carry distinct contractual and legal rights. They pass the test, so we slice their value out of the purchase price and add them to the balance sheet. Next is the non-cancelable contract to supply training services to a major client. While this agreement cannot be sold separately, it represents a legally binding right. It is recognized as an asset, and another slice falls from the purchase price into our intangibles. Finally, we address the workforce. The training company's highly skilled staff was a primary reason the bank paid a premium. This fails the recognition test. The acquirer does not control the employees. A workforce is not legally separable, nor can it be contractually owned. Despite driving the success of the business, the workforce remains invisible to the balance sheet as a distinct asset. We've carved out the tangible assets and the legally defined intangibles, yet a portion of the initial purchase price remains unaccounted for. This leftover residual amount is labeled as goodwill. Goodwill captures the remaining value required to balance the M&A accounting equation. It subsumes the value that could not meet the legal criteria. The workforce and expected future synergies are absorbed into this block, balancing the final equation. This figure is parked on the consolidated balance sheet as an intangible non-current asset. It is a permanent record of the premium paid above the fair value of the identifiable net assets. Acquisition accounting functions as a check on corporate valuation, ensuring that every dollar spent is tied to a verifiable asset or a labeled residual. This deconstruction shows the structure beneath the surface, replacing an unexplained cash outflow with a categorized map of value. Corporate value is limited to what a company can mathematically and legally prove they control.